Right now, everyday investors are stampeding for the exits, convinced the digital asset market is collapsing. But while the public panics, the largest financial institutions on Earth are standing perfectly still, quietly accumulating the exact assets retail traders are throwing away. Look at this gauge tracking current market sentiment. It is dropping aggressively into the red, locking in at a bleak 8%. In financial metrics, this registers as extreme fear, a level that routinely triggers widespread capitulation. But behind closed doors, a completely different reality is playing out. Financial titans are aggressively spending billions of dollars to buy up the underlying infrastructure of the crypto market. That 8% fear reading is doing exactly what it was designed to do. It shakes nervous retail investors out of their positions, clearing the board for a massive, coordinated transfer of wealth into institutional hands. The hard evidence for this institutional takeover is buried in the regulatory paperwork. Evernorth has just submitted an S-4 filing, a mandatory document used for corporate mergers, with the SEC. In that filing, Evernorth outlines an acquisition of Armada Corp with a highly specific objective. They intend to build the largest publicly traded XRP treasury company in the world. Their endgame bypasses traditional crypto exchanges entirely. Evernorth plans to trade directly on the NASDAQ, operating under the actual ticker symbol XRP. By listing directly on the NASDAQ, Evernorth grants legacy investors direct, regulated exposure to digital assets. Wall Street traders can now hold a massive stake in the network without ever having to set up a crypto wallet or navigate a digital exchange. To understand why legacy banks suddenly have the confidence to orchestrate corporate maneuvers on this scale, we have to look at a recent shift in the law. The trigger was the Genius Act of 2025. This U.S. legal framework explicitly removed the crippling regulatory red tape that had kept traditional finance sidelined from digital assets for a decade. The clarity provided by the Genius Act operated as a starting gun. Overnight, it legally cleared the path for institutional capital to flow freely into stablecoin and blockchain companies. Wall Street's current buying spree is highly coordinated. Enabled by the Genius Act, these financial giants are executing a legally sanctioned land grab. We can see the immediate corporate action triggered by this legal shift by looking at Mastercard. The legacy payment network has suddenly and aggressively entered the digital asset space. Mastercard just executed a staggering $1.8 billion buyout of BVNK, a 5-year-old startup specializing in stablecoin architecture. This flowchart maps exactly how BVNK's mechanical function works. It builds the necessary back-end plumbing to seamlessly route fiat, which is traditional government-issued money like the US dollar, straight from standard bank accounts into digital stablecoins. Legacy payment giants recognize the superior efficiency of blockchain networks. Rather than trying to compete with the technology, they are spending billions to outright own the bridges that connect it to the traditional banking world. As Mastercard buys the plumbing, asset managers are quietly preparing to distribute these assets to Wall Street clients. Grayscale is leading this effort through strategic repackaging. Ray Sharifi, Grayscale's head of product and research, recently went on record with a very specific classification, publicly championing XRP as a battle-tested blockchain. Look at this taxonomic tree detailing their financial structures. Grayscale has anchored their entire currency sector around XRP, formally establishing it as the foundational base asset that supports the rest of the portfolio. By structuring it this way, Grayscale is setting the stage for an XRP ETF, an exchange-traded fund that tracks the asset's price. This final regulatory step opens the doors to highly conservative institutional investors who are strictly mandated to buy through regulated traditional financial vehicles. This brings us back to Evernorth's NASDAQ filing. This document outlines a highly calculated macroeconomic strategy disguised as a standard corporate merger. Evernorth is directly copying the MicroStrategy playbook. MicroStrategy achieved massive financial success by using their corporate structure primarily as a vehicle to hoard Bitcoin. This line graph compares a corporate Bitcoin treasury against a projected path for Evernorth's XRP model. Utilizing a public corporation strictly to hold XRP creates a massive supply shock. Vacuuming up available supply starves retail liquidity, aggressively driving up institutional equity value. The smart money is entirely uninterested in day trading. They are weaponizing corporate structures to permanently monopolize the underlying supply of the asset itself. Compare these three massive institutional maneuvers: Mastercard's $1.8 billion infrastructure buyout, Grayscale's ETF push, and Evernorth's corporate treasury filing against that initial 8% retail fear metric. Wall Street relies on that exact panic. They require everyday investors to sell out of fear so they can acquire foundational, battle-tested assets at a severe discount. The data is sitting right there in the SEC filings, mapping out billions of dollars in active corporate acquisitions. You just have to look past the engineered market sentiment to see it. The old guard is moving aggressively to finalize ownership of the Internet of Value. And the window to front-run their corporate filings is closing rapidly.
Stay ahead in the crypto market. Subscribe now for the latest global news and updates.